Have you ever heard the term, you finance everything you buy? Now, let's dive into that a little bit closer. Now, if ever you're going to buy anything, you really have two options. You can pay cash or credit. So we all know that if you pay with credit, you're going to have to pay somebody interest, right? But did you know that if you pay cash, you are giving up the ability to earn interest? And we call that opportunity cost. Now, an example of that opportunity cost is because you paid cash, you must have taken that somewhere from some account. And what would have been the best use of that? What could you have earned if you had that money in that account working? And if you take that out of that account, the potential income you lost is considered the opportunity cost. So let's draw a diagram here to see how that works. Let's say that this is $0. Now, if you were to finance something, you have two options. One is, which most people do, they use credit. So they immediately go into debt, but now they need to pay that back. So they will slowly pay that off and be back to zero. And then let's say it's for a car. What do most people do when the car's paid off? They go back into debt again for a second car. And then they do the same thing, and they eventually pay off their debt. And then what do? They buy another car. Now, the other way to do it is to pay cash. But in order for you to do that, the first thing you need to do is you need to save up enough cash so you can buy the first car. So you have to prolong the car, and then once you have enough money built up in your account, you actually drain your account down to zero. And now you have the car. But you know you're going to need to buy a second car, so you need to save up for car number two. And then you do the same thing. You drain your account down to zero, and then you start saving again for the third car. Now, if you had to choose between the two, which one would you choose? Now, first thing you're probably saying is, well, I don't want to go into debt, and because I don't want to have to pay interest. Because we do have to realize that when you're financing a purchase, you're actually using somebody else's savings. So you're going to have to pay them interest. So your actually balance is kind of more like this. This is the interest that you are paying. So most people would rather pay cash because they don't want to pay somebody that interest. But what another intangible is, when you borrow money from somebody else, who sets the terms? That is somebody else. That's the golden rule. He who has the gold makes the rules. And you have to pay them on their terms. But when you have control of your cash, you can determine at what rate you want to save. Maybe you save a little bit more, or when things are tight, you can save a little bit less. But not only are you saving the interest, you are also maintaining control of your money. But no matter which one you prefer to do, one key thing is that they end up in the same spot. They still end up at zero. So there actually is a better way, a third way, and that's called the infinite banking concept, or we call it IBC for short. And in doing that, we will save, but I tell you at the beginning, we are going to be a little bit behind the saver, okay? But we will catch up. But what will happen here is instead of draining our account still continues to compound. So now what we can do, instead of draining that account, we can borrow against that account. And it looks like this. You go into debt to yourself, then you pay yourself back for card number 1. And then you do the same thing. So a key things here is you don't lose that interest that you'd be paying to someone else, and also you don't lose the opportunity cost. And in addition, you always maintain control of your money. So if money is tight, or there is a family emergency, or life happens, or maybe there's another opportunity to use your money, you do not lose the compounding effect of your money. Thank you.